Hi, welcome to Market Week in Review for the week ending February 28th, 2025. I'm Paul Edelman, and I think the main message out of financial markets this week was one of a risk-off tone. We had the U.S. equity market as measured by the S&P 500 index trade down about 2.5% through Thursday's close here in Seattle, and 10-year Treasury yields declined as well. If you go back to mid-January, the recent peak in yields, they've now fallen 50 basis points, which is a pretty substantial move in a short period of time. In terms of drivers for that, three things stood out to me driving the market action this week. I'd say first, we've had a bit of a sell-off in the U.S. mega cap tech names. Second, a lot of policy uncertainty and proposals from the new U.S. administration. And then third and finally, at the margin, some disappointing macro data out of the U.S. economy. So if we start with the mega cap tech sell-off, really the main macro market event this week was NVIDIA's fourth quarter earnings results that came out on Wednesday's close. Those earnings did beat consensus expectations, but not by nearly as much as what we'd seen over the past several quarters. And on the back of that, NVIDIA's stock sold off over 8% in Thursday's session here. More broadly, if you kind of zoom out over 2025 as a whole, we've started to see some broadening out and rotation in market leadership, where the so-called Magnificent Seven stocks are actually underperforming the other 493 names in the index by a substantial margin, 12 percentage points year to date in 2025. And half of that came just in this week's alone. So definitely a notable sort of rotation coming through in the market, which was one of the themes that we were thinking of in terms of our outlook for the new year. Second, policy uncertainty. Trade continues to be a focus point for the new U.S. administration. President Trump this week sounded very serious in his intent to push forward on his proposed tariffs against Canada and Mexico. He also mentioned that he'll put in place an additional 10% tariff on U.S. imports from China, with all of those measures to take effect on time next week on March 4th. And so that seriousness around potential follow-through on trade also contributed to some incremental risk aversion this week. Third and finally, I mentioned U.S. growth concerns. The U.S. business cycle has been positively surprising pretty consistently since October of last year. At the edges, and I think this is just incremental right now, but at the edges, we had some more downbeat data this week. We had a pickup in initial jobless claims, which we'll have to keep an eye on now over the next couple of weeks. Some of that came out of Washington, D.C. and might be related to the DOGE efforts to streamline the U.S. government and make it more efficient. We also had a step down in consumer confidence. I think broadly speaking, as we're kind of viewing the U.S. economy today, we're continuing to see a pretty solid foundation of fundamentals into all of this policy uncertainty, where we think we can still see resilience and a soft landing going forward. But what actually happens on policy is going to be quite key to those outcomes. But yeah, ultimately a risk-off tone. On the back of that, though, we are starting to see some pessimism creep into our measures of market psychology. And I would say for long-term investors, times of uncertainty and pessimism like this are usually good times to be in the market and in the game for solid returns over the long term. So anyway, that's what stood out to me this week. Thanks for tuning in, and we'll see you next time. Thanks a lot. Bye.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.